Hi everyone, this is Dao Chai. I'm at the University Library right now. If you guys hear students talking in the background, sorry about that. Okay, so we are going to be looking at prepaid expenses. So this is going to be part 6 of analyzing business transaction. Okay, so let's start off with a little inspiration. So Benjamin Franklin. All right, so an investment in knowledge always pays the best interest. Okay, so companies record payment of expenses that will benefit more than one accounting period as asset. So these prepaid expenses uh, re- or prepayments are expense paid in cash before they're used or consumed. So when expenses are prepaid, an asset account, an asset account increases debits to show the service or benefit that the company will receive in the future. So, for example, account prepayment are insurance, supplies, advertisement, and rent. So, in addition, companies make prepayments when they purchase buildings and equipment. Right. So, for prepaid expense, our cost that expires either with the passage of time, e.g., rent and insurance, or through usage, e.g., supplies. So the expiration of these costs does not require daily entry, which would be impacted and unnecessary, impractical and unnecessary. So accordingly, companies postpones the recognition of such costs expiration until they prepare financial statement at each statement date. So they make adjustment entry to record the expense applicable to the current accounting period and to show the remaining amount in the asset account. So prior to adjustments, assets are overstated and expenses are understated, right? So therefore, an adjustment entry for the prepaid expense result in an increase, a debit to the expense account, and a decrease, a credit to the asset account. Okay, so let's look at supplies, right? October 5th, purchase supplies, we record that asset. October 31st, we use supplies, right? Record supplies expense. So the purchase of supplies such as paper and envelopes result in an increase, right? A debit to the asset account. During the accounting period, the company's supplies rather than recording uh, rather than record supply expense as the supplies are used. So companies recognize the supplies expense at the end of the accounting period. At the end of the accounting period, the company counts the remaining supplies. The difference between the unadjusted balance in the supplies asset account and the actual cost of the supplies on hand represents the supplies used, an expense for that period, right? So our company purchased supplies costing $2,500 on October 5th, and we record the purchase by increasing debit. So we're debiting the asset supply account. The account shows the balance of 2,500 in the October 31st trial balance. So as a physical count of the inventory at the closing of the business on the 31st reveals $1,000 of supplies are still on hand. So thus the cost of supplies we used was $1,500, right? So we used $1,500 worth of supplies. So this use of supplies decreased the asset supply account, and it also decreased the stockholders' equity by increasing the expense account supplies expense. Okay, so this is how it's going to look like. So after the adjustments, the asset account supply shows a balance of $1,000, which is equal to the cost of supplies on hand at the statement date. So the supplies expense shown a balance of $1,500, which equal the cost of supplies used in October. The company does not make the adjustment entry. The October expense will be understated if the company doesn't make the adjustment entries. Then our expense will be understated. Okay, so that's why we need to make those adjustments by $1,500, and then net income will be overstated also. So moreover, both asset and equity will be overstated, right, on the balance sheet. So that's why we need to make these adjustments. Okay, so take a look at how we analyze, did the journal entry, and then we post it. Okay. All right, so insurance. So the company purchased insurance to protect themselves from loss due to fire, death, and unforeseen events. Insurance must be paid in advance. So often for multiple months, the cost of insurance is a premium paid in advance, right? So we record an increase, a debit and asset account for prepaid insurance. So at our financial statement date, the company increased debit insurance expense and decreased credit prepaid insurance for the cost of insurance that has expired during the period. So right here we see October 4th, right? We purchase insurance, record that on our asset. We paid $600 for the whole year. So on October 1st, we record the payment by increasing the debit prepaid insurance account. This account shows the balance of $600, and then in our trial balance, right, for October 31st, what we did was we got the 600 divided by 12 months. That gives us $50 expiring each month, right? So expiration of prepaid insurance decrease on asset. So the prepaid insurance decrease stockholders' equity by increasing expense account and insurance expense. Okay, so I'll explain on the next slide. So the asset prepaid insurance shows a balance of $550, which represent the unexpired cost for the remaining 11 months. So at the same time, the balance insurance expense equals the insurance cost and the expired in October. So if Sierra does not make the adjustments, the October expense are understated. So that's why we gotta make sure we make those adjustments, right? We don't want to understate or overstate asset or stock holders' equities. Okay, so take a look at that. All right, guys, that was quick. Thanks.